Some other big deal news today. Kroger, the world's largest grocery store chain, has agreed to buy Harris Teeter Supermarkets. It's a chain of 212 stores in the Southeast that would help Kroger, known for its Ralph brands on the West Coast, or Cincinnati Kroger, as well as dozens of other brands, expand in the region. Joining us now from Cincinnati is the company's CFO, Michael Schlotman. Michael, good to see you. Thanks for being with us on this day where you have an exciting
thanks for having me.
Announcement. Talk about the competitive edge that you're hoping this acquisition will give you in boosting your portfolio of grocery stores.
Well, you know, the Harris Teeter brand is a chain of stores that we've long admired. They bring a great focus on fresh product and prepared foods to our organization. We think it's actually something we can leverage across our entire chain, and it gives us an entry into some very big, dynamic, fast-growing markets: Charlotte, North Carolina, Washington, D.C., and Baltimore, Maryland, to name just three. We're really excited about the prospects going forward.
Michael, I'm not sure the best measure of profitability in the supermarket business, but at the very least, Harris Teeter appears to have some pretty great pre-tax margins, pre-tax profitability in the order of 3 to 4 and sometimes in excess of 4% over the past several quarters. That compares to somewhere between 2 and 3 for Kroger. What are they doing right that Kroger could adopt to get those margins?
Yeah, I think one of the things they do is they get a better mix on the fresh side of the store that has a higher gross profit margin than the store as an average. So that's actually one of the things we think we can learn from them. When we look at mergers, we look at things that we can take both ways. There are certainly some leverage of our scale we can bring to them, but their ability and their skill on the fresh side of their store is something we think we can replicate broadly within Kroger.
Who is your biggest competition, Michael, and how does this fit in with your overall strategy for the company?
Well, all the markets that Harris Teeter is in has a great amount of competition. If you look down in the Charlotte area, it's pretty much the traditional folks that you would see anywhere. Publix has been coming into that market. Food Lion is obviously there. The Walmart supercenters are there. As you go up the coast and Hampton Roads, certainly Walmart is there. You have Farm Fresh there, and as you get up into the D.C. area, you have Giant stores, you have Wegmans in that market, and that would be very similar in the Baltimore area. And as well, you would have the Walmart competition in those markets as well.
Michael, who were you competing with to acquire Harris Teeter? We heard a couple of weeks ago that Publix was sniffing around, perhaps, maybe even Cerberus. How competitive was it?
You know, the speculation's out there that there were other people looking at it. I don't really know. It's not something that I would have been privy to. Anybody that would have been looking at it, both sides would have been subject to a confidentiality agreement. But obviously, any other activity that was going on, when they filed their proxy for shareholder approval, they would have to describe the process they went through before their board last night unanimously accepted our offer for merger.
Well, what if other bids come in, which some analysts suggest could still happen? Would you be willing to pay a higher price?
Yeah, I couldn't speculate on whether or not I would do that. There are provisions in the merger agreement that should be filed on an 8K that we both filed here recently. If they get a superior proposal and it's something we choose not to match, there are breakup fees that would be due to us. And there is a no-shop provision in the merger agreement where they cannot go out and shop the asset. But obviously, their board, from a fiduciary standpoint, if other proposals came in and they viewed them superior, we would have to have further conversations with them.
Michael, what is the breakup fee?
The breakup fee from their side is $75 million. It's embedded in the merger agreement.
So a pretty standard 3%. We've seen this in other transactions. But there's also a non-solicitation agreement. Why the non-solicitation agreement, which I presume you and your bankers insisted on, when you have this breakup fee making it that much harder, raising the hurdle that a competitive bidder would have to clear?
We felt it was important that they don't continue to shop this asset. One of the things we want to try to bring to the Harris Teeter family is some sense of stability. There have been rumors in the marketplace since as far back as February that a transaction was simmering, and we wanted to try to bring some certainty to their associates that with this merger proposal, they're joining a company that has done this many times and kept the best of what that brand means when they join the Kroger family, and we have every intention of doing that with the Harris Teeter brand. And that's the biggest reason, is to bring stability to all the great Harris Teeter associates out there.
Michael, are you considering any other M&A activity or opportunities?
Well, there's always things out there. Obviously, this being funded with debt, I made a commitment to use some of my free cash flow to pay some debt down to maintain a net total debt to EBITDA ratio that's going to keep my mid-BBB credit rating, which I know all of the rating agencies should be coming out today and confirming. I've been a little busy this morning. I haven't seen everything that's been out there, but I know for sure Fitch has come out and not only confirmed the mid-BBB, but our stable rating as well.
Michael, on an EBITDA multiple basis, this looks a little expensive. Our calculations suggest almost 8 times trailing EBITDA. Why pay that much?
Yeah, if you look at it on the standpoint, they just finished their third quarter of this year, and if you look at expectations that are out there, the numbers from the Wall Street analysts, it would be between 7 and 7.2 times their current annual estimates, consensus estimates for the year. This is an asset that we've long admired. They've historically traded a little bit above average, and it gets us into some great fast-growing markets with a great store base, not only to fill in a market like Charlotte, but to really grow from in a great market like D.C.